Well, good morning and welcome to the Reserve Bank, and thank you for coming along this morning. With me I've got John McDermott, who's the Assistant Governor and Chief Economist, and also Willie Chetman, who's Manager of the Forecasting Team. The Reserve Bank today is increasing the official cash rate by 0.25% to 2.75%. This is needed to help contain the rising inflation pressures associated with the strong economic expansion that is becoming increasingly broad-based. Several factors are driving this expansion. Our terms of trade are at a 40-year high. Dairy prices are up 43% over the past 12 months, and prices of most of our other commodities are strong. The decline in policy rates to a 50-year low has stimulated demand. Residential investment is up around 40% over the past 2 years, and investment in Christchurch reconstruction is expected to be $1.5 billion higher than last year. And the rapid increase in net immigration over the past 18 months is boosting housing and consumer demand. Business and consumer confidence is at multi-year highs, and hiring and investment intentions are increasing. We are seeing some moderation in the housing market. Loan-to-value restrictions are starting to ease pressure, and rising interest rates will have a further moderating influence. However, the rise in net immigration flows are adding to housing pressures. Inflation pressures are starting to increase and are expected to do so over the next 2 years. We want to keep inflation expectations contained. In order to do this, we need to raise interest rates to a level where they are no longer adding to demand. How much and how fast we need to raise rates will depend on the data and our assessment of emerging inflation pressures. Our clear goal is to contain inflation, and in doing so, help ensure that the economic expansion can be sustained for as long as possible. Thanks very much. Happy to take any questions.
The statement doesn't hold out much prospect of relief on the exchange rates this year, and I wonder about your level of concern about putting further upward pressure on the dollar by getting out ahead of the international pack in terms of interest rates.
It's true that we're leading the tightening phase amongst the advanced economies. And it's true also that our exchange rate is high by historic standards on a TWI basis and against most of the major bilateral crosses. So it's within the top 10% of past historic experience. You know, if you look at why is the exchange rate so high? A major reason is the terms of trade. If you look at the track of the exchange rate and the track of the terms of trade, it has a pretty strong correlation. Another factor is that the countries that represent 2/3 of world output, and so that's the G7, the 18 countries of the Eurozone, Switzerland and Sweden, add them all together, they're about 2/3 of world output. Their policy rates are still at 0 to 1%, and for most of those countries, they're likely to continue to be in that range for quite some time. So the exchange rate pressures are a concern for us, but you know, we also feel that we've telegraphed these moves quite carefully. I mean, we've been talking about concerns in the housing market, concerns about rising inflation pressure. So I don't think it's any surprise to the market, and I think most institutional investors are anticipating this sort of tightening, and so therefore we're not expecting to see any significant exchange rate increase as a result. Right.
Yeah, further to the exchange rate, because I notice you've got, you say in the document a couple of times that the current levels are unsustainable, and yet if you look at the CWI track, it still stays fairly high. So, I mean, aren't you implicitly saying, well, you know, sustainable or not, this is what we've got to live with here?
Yeah, I mean, that's the truth. I mean, that's exactly what we do have to live with. I mean, you know, there are clearly negative effects in terms of headwinds in the tradable sector for exporters and import substitution industries, and particularly those exporters that are exporting to Australia and therefore manufacturing exporters. Commodity exporters have had the benefit of the terms of trade increase. But we live in a world where our currency is the seventh, it varies between the 7th and the 10th most traded currency internationally. So daily turnover in the foreign currency markets is around 100 billion New Zealand dollars. Now, about 90% of that takes place offshore. So our currency is enormously intensively traded. And just to give a benchmark, I mean, if you've got daily turnover in the FX market of, say, 100 billion a day, you know, New Zealand's GDP is, what, about 180 to 200 billion. So it's a huge amount of FX activity that's taking place, and it's driven by the sorts of factors that I talked about in answering Brian's question.
How much of a consideration was unemployment in your decision making, and do you agree with some of the suggestions, I think from the Greens and others, that this increase will lead to job losses?
No, I think Russell Norman's referring to a bit of work that we did, which was essentially saying it was like a theoretical thought experiment. It was an unanticipated rise in interest rates of 1%. So completely unanticipated, so it's a shock to the market. What's the output and employment effects of all that? In practice, interest rates are set in response to the economic cycle and what's going on. So if you look at our forecasts that we've got here, we're still, despite the interest rate track that we've got there, with, say, the OCR rising 2 to 2.25% over the next 2 years, we still have employment growth of 105,000, and the unemployment rate in the forecast falling to just below 5%.
Expect the OCR to track for the rest of the year. Do you think we'll end up 3.5% up to 4% by the end of this year?
The path we've got in the forecast has about 125 basis points built in for this year, 100 to 125. Now, the market, in terms of its forward pricing, has built in about 110 basis points for this year.
Does the timing of the election have any bearing on the timing of the rate hikes?
No.
I'm thinking particularly of the September EPS, just basically a week before the election.
No, we'll make the judgments in terms of our responsibilities. In terms of the Reserve Bank Act, we'll make them according to how we see best in terms of inflation pressures and the path of the economy.
You give your rate projection to 5.3% by early 2017. Do you see the possibility of that rising beyond that?
Well, there's always uncertainty. I mean, if you look at forward rate projections that any central bank provides, and many central banks do incorporate them in their forecasts. I mean, it's just like forecasting the real economy. The degree of certainty starts to starts to, or the degree of uncertainty, if you like, starts to increase as you go out. So it's mainly over the next 2 to 3, 4 quarters that we have the greatest confidence. But look, if inflation pressures started to rise more than we anticipate, and it requires higher interest rates, then we will make that adjustment.
Graham, you say that the LVR impacts appear to be front-loaded. Does that mean that the major impact of the LVR restrictions has probably has either occurred now or is close to having occurred? And I guess allied to that, have they had as much impact as you would have expected or hoped?
I don't think we're going to know the full impact or a lot of the impact, if you like, of the LVRs probably for another 3 to 4 months. What we can say at this point is that on a monthly seasonally adjusted basis, house sales are down 13% since September. In Auckland, they're down 15%. And if you look at the seasonally adjusted Real Estate Institute of New Zealand Stratified House Index, that's a mouthful, I know, the house prices for the last 4 months are up 1%. Now, if you take the 4 months before that, they were up 4%. So we're seeing a reduction in house sales, and we're seeing some moderation in house prices or house price inflation. We did some modelling work just recently, which was to look at what would have been the effect of house price inflation if we hadn't introduced the LV ratios. So what would the counterfactual have been? So that if the banks were lending something like 25 to 30% of their mortgages to high LVR borrowers instead of currently 7%, what would house price inflation have been doing nationally? House price inflation is currently running at around 8.4%. We think it would have been another 2.5% on top of that. So it would have been running at around 11% based on our modelling. So we do believe the LVRs are starting to have quite an impact.
I just want to clarify, did you say earlier that you're expecting 125 basis points, so we're looking at 4% OCR by the end of the year?
It's, well, the forecast track builds in 100 to 125 basis points, so 1 to 1.25% on top of the 2.5 where we are now.
Obviously, there are some political parties which are suggesting changing the Reserve Bank Act. Are you aware of any evidence that would suggest increasing the things that you consider when making the decision, adding something like specifically unemployment, etc.? Is there any evidence to suggest that would lead to potentially lower interest rates or a lower interest rate cycle?
No, we don't believe so. I mean, look, the Reserve Bank, there's this question of central banks always take away the punch bowl, that sort of thing. You get so focused on inflation. There isn't a central bank in the world that I know, and it's certainly true of this one, that doesn't think about the real economy, about the exchange rate, about unemployment when it's looking at monetary policy settings. And a big reason for the strength of the recovery is the fact that we lowered interest rates to their lowest in 50 years. I mean, this is the first essential significant tightening phase for 5 years in this economy. So the Reserve Bank, I think, along with some very prudent government policy, particularly around fiscal policy, I think played an important role in getting this recovery underway. What we want to do is to contain inflation pressures so that we don't have excessive tightening, we don't lose competitiveness, and we want to contain those inflation pressures so we can sustain this recovery. We want it to go for as long as we possibly can.
Governor, just on the LVRs again,
With the banks getting through their 6-month sort of phase-in period by the end of this month, I guess having worked through a lot of the pipeline, are you expecting them to start increasing their high LV lending?
Well, they're running at around 6 to 7% at this point. Remember, the target was 10%, and there were exemptions for another 5%. But in fact, total lending is running at around 6 to 7%. I think as they get more accustomed to the LVR framework, that percentage of lending will start approaching the 10% again, possibly with a little buffer, but I think we'll see an adjustment upwards.
Governor, you've spoken in the past about how your experiences in the States have shaped your thinking. I'm wondering, you're the first central bank in the developed world to raise rates today. To what extent has your experience shaped today's, or played a role in today's move? To what extent, perhaps, is there a feeling that central banks in the past have waited too long to raise rates? Is that part of your thinking?
Well, I think we've all learned from long ago about the experience of the 70s and about high inflation, etc. But let me put it this way: this recovery is becoming increasingly broad-based. It's a strong recovery. It's got many factors driving it, and I talked about those in my opening comments. And one way to think about it is to say, what could slow the recovery? What could cause the recovery to stop? And you could say, well, a major slowdown in world growth might do that. And then you say, well, is it likely that the world is going to go into a recession at some point? It could happen, maybe, but it's not likely. The consensus forecasts are that that's not going to happen. The economy could slow dramatically if we had a sharp decline in the terms of trade. It doesn't seem to be likely. The terms of trade look strong and likely to hold up there for quite a period. You could see mistakes in macro policy. You could see reckless fiscal policy that would drive a recovery into difficulty. But the government's talking about balancing its books in 14-15 and then running surpluses. It could be a sharp fall in house prices, but then you'd say, well, what would trigger it? Maybe China or issues there. So you can go through a lot of things and say, well, these things could stop a recovery, but the chances are probably reasonably low. But one thing that does stop recoveries in small open economies is inflation getting out of control. Because it starts to undermine the growth in real income, it starts to undermine the competitiveness of the economy. And that's the thing that we want to avoid. We want to move early, we want to contain inflation expectations, and we want this recovery to go for as long as possible.
The report notes 73% of mortgage borrowers are either on a floating rate or they will need to refinance on a fixed rate within a year. Based on what we know from the past, what are your expectations, or what are the implications, do you think, of that for the way that households are likely to adjust to rising interest rates?
This is as I said a moment ago, this is the first significant tightening phase, I think, for probably 5 years. So there's a lot of borrowers out there that have never been through a phase of rising interest rates. And you're right, 73% or roughly 3/4 of borrowers are either on floating or fixed for less than a year. So these interest rate increases will start to affect their debt servicing capacity. And that's one thing that we'll look at quite closely as we go through this tightening phase, to see how the households react to the increase in interest rates.
I think in a speech in October, possibly, Mr. McDermott made a reference to the neutral cash rate being around 4.5%. But this forecast, the 90-day bank bill track is at 5.3 at the end of 2017. Does that mean that you've moved the neutral cash rate higher?
No, we still have a view that neutral interest rates are around 4.5, and the interest rate profile goes slightly above them to make sure we contain future inflation.
Governor, you see a slightly steeper inflation track coming over the years. I think non-tradables going up to 4% next year. You say that you're not anticipating as much of a spillover from the Canterbury rebuild. Where are you seeing those inflationary pressures coming?
Well, some of it's construction cost inflation. I mean, construction costs in Canterbury are running at around 10% on an annual basis. In Auckland, they were running at around 2% a while back. They're now up to about 4.5%, and nationally they're running about 4.5%. So that's some of the cost pressures. Some of it's coming through in terms of government charges, but other parts of it we think will become more apparent in terms of wage demands. I mean, the unemployment rate is in these forecasts heading towards 4.75% to 5%, and as the labour market tightens, we think we will see some of those wage pressures starting to build up. We're already seeing it in Canterbury. But John, did you want to add to it, or Willie?
Just quickly, I mean, as the economy gets going and the recovery takes hold, we'll see demand pressures actually throughout the economy. And some of the big drivers are just the extra income we're getting from terms of trade, for example. Generally, the housing market and the construction in Canterbury will all add to demand pressures across the entire economy. And so we'll see it quite diffuse in all the prices.
I note you noted in there the growing demand for exports to China, and obviously that's been exploding over the last couple of years from New Zealand. Are you at all concerned that New Zealand's becoming too dependent, in particular on dairy, the dairy part of it, in terms of exports to China? Are we putting our eggs in one basket there?
I think there is an issue of concentration. I mean, if you look at China's share of our export trade, for example, it's gone from about 3% to 21% or 20% roughly in the last decade. So it's now number one, and Australia's slightly behind in second place. And if you look at sort of dairy exports and you look at Chinese imports of dairy and particularly milk products, milk powder and that, we account for about 80% of China's imports of milk powder. I mean, that's very significant. So we do have a lot of dependency on China, and I think it is something to think about. You want a more diversified export basket if you possibly can. But did you want to add anything, John?
It's sort of a mixed blessing, isn't it? Of course, you want the growth coming from somewhere, and it's not that we've stopped exporting elsewhere. But sure, if something was to happen in China, it would have implications both here in Australia.
You mentioned in here that the surge in net migration is a factor boosting demand. Do you think there's a role for some types of controls on migration to give you some help on a monetary policy front?
The impact of migration's been pretty significant. I mean, the turnaround from minus 4,000, say, in mid-2012, which it was on an annual basis, to something like 26,000 is a very big turnaround. I mean, our forecasts, I think, have it going up to around 35 and then starting to decrease. There are lots of pluses and minuses about migration in terms of demand and supply, the availability of skills, the technology that can be introduced, basically the different mix of skills, etc. Now, I wouldn't think of it in terms of policies and in connection with monetary policy in any way.
Do you think that the migration surge is responsible at least for part of the increase in interest rates that you forecast here?
John, what do you think?
Yeah, just going back to your first question, the big thing that's driving net migration at the moment is New Zealanders not leaving. I can't see any controls that would be reasonable changing that. And the fact that there's now more people means there's more demand for goods and services, particularly housing, and it is part of the story. It is one of the things that is driving this economy forward.
Just thinking about the outlook for the remainder of this year, you've got, I think, potentially, 6 more policy statements and potentially 4 more quarter-point moves. Looking at the 90 bank track for your 90-day bank bill yield, is it fair to assume that you're going to want to front-load most of those moves and look to perhaps pause later in the year?
I think, as I said, we'll look at the response of householders to the interest rate rises, but I think it's also fair to say, over the next few months we will see further interest rate increases. Sure.
Governor, the moderation in house price inflation, what kind of breakdown do you ascribe to, I guess, the increase in interest rates, or expected increase in interest rates, the LV restrictions, and I guess some of the construction activity sort of bringing on supply to the market?
Our concern has always been between the mismatch between supply and demand, if you like. On the demand side, you had a lot of pent-up demand. You had interest rates at the lowest for 50 years. You had supply shortages in some parts of the country, especially Auckland and Canterbury. And our concern was that it would take a long time for that mismatch to sort of equilibrate or settle down, so that it didn't lead to very substantial and prolonged increases in house prices. Building permits are picking up quite substantially now. They're running in Auckland, I think, probably around 6,500 to 7,000 at this point, instead of 3,500 to 4,000, which they were for a long time. That's really important. I think the LVRs, as I said, have had quite a significant effect. And I think that the tightening in interest rates that we will see in the months ahead will also start to have a significant effect, particularly given how much of the mortgages are floating or fixed for less than a year.
Governor, could you talk a bit more about how much traction you think this rate hike might get, given the amount of people who have fixed this time versus what we saw in the last extended rate hike cycle?
Do you want to have a go at that, John?
Bernard, you might remember the last time it was quite a frustrating exercise as we moved interest rates. And most households had 2-year, 3-year, or even up to 5-year fixed mortgages. It took a long time for the transmission channel to actually work. You've almost answered your own question. With most people on floating or less than a year to be fixed, the immediate impact will come through a lot faster. So we think it'll be much more rapid than the last cycle. And the other thing we're paying attention to is the behavioural response. It has been a long time since households have seen an interest rate cycle. And so we do really have to feel our way through this to see what the reaction would be, because there could actually be an even overreaction compared to history.
On the issue of bank profit margins, which you mention in here, have certainly term deposit margins have increased. Is there a risk that the banks could use those firm margins to not pass on the interest rate increase by essentially not increasing floating rates or fixed rates by as much?
I think floating rates will move or adjust pretty quickly, instantaneously, one would think, for new borrowers, and I assume in just a matter of 2 or 3 weeks for existing borrowers. How much fixed rates move will largely depend on activity in the swap market. So, for example, if there is a move to fix as a result of an anticipated increase in rates over a significant period, then that will increase swap rates, and that will feed through into fixed term rates.
A lot of term depositors have been hanging out for higher rates. Given that the banks seem pretty flush, would you expect this rate hike to be passed on to term depositors, or might they miss out this time?
Yeah. You have any thoughts, Grant or John?
It'd be interesting to watch. I mean, traditionally what you see is mortgage rates, interest rate increases in mortgage rates happen first, and interest rate increases through to deposit rates tend to be slower. And that's what we've seen in the past. I wouldn't expect it to be that different this time around.
I just wanted to pick up on your response to one of the earlier questions about a possible overreaction to the hike. And I was wondering what you would consider an overreaction and what the components of that might be.
I mean, I was talking about behavioural responses, so it's something we have to watch. There'll be some people with a mortgage that have never had a mortgage, say 5 years ago, haven't been through an interest rate cycle. There'll be some people who might be considering a mortgage and suddenly realising interest rates can actually move, and they might be a lot more nervous about what the implications are. And so we're talking about very prudent behaviour might be coming in. And they might be watching what develops. And so we might see the housing market slow down even more rapidly than it has in the past 2 cycles. This is all supposing and risks we have to manage. It's not saying it will happen, of course.
So if you take household debt as a share of household disposable income, I mean, in the early 90s, that was 60%. And it had risen in the year 2000 to about 100%. It's now 146%, and it's starting to rise again. Fell a bit after the GFC, but it's now starting to rise again. So if you see rising mortgage rates or rising interest rates over a significant period of time, then the debt affordability or the debt sustainability is going to be uppermost in borrowers' minds, I think.
Yeah, that sort of feeds into my next question, which is actually not so much about what's in this document, but what was in your last financial stability report, where there was a table there about the debt servicing ratio. I forget the exact term, but it's still sitting quite high despite low interest rates, and the extent to which that is going to curve quite steeply given, I guess, other cost pressures in the economy, energy costs being the topical one at the moment.
And I'm not sure I can comment other than to agree. It's an issue. But let's see did you want to add anything, Grant or John?
The debt service ratio had actually, has been at relatively low levels, has come off more than the debt ratio since the GFC because of the low interest rates. So now it will be going up to historic back up towards the GFC type levels, and it will put pressure on.
Your question around the timing of the election and the interest rate hikes. Are you worried? We've seen in Australia before interest rates become a political football. Are you worried that there are signs of that interest rates may become a similar issue here during the election, and how will that affect you?
We've had no pressure whatsoever from the government in respect to monetary policy decisions or in particularly interest rate decisions. None at all. And I wouldn't expect that in the lead up to the election.
The monetary policy statement talks about the impact of the high LVR speed limits and that they seem to have worked. What's your view currently on how long they might be in place and whether or not they could be scaled back, or perhaps whether they should be scaled up?
Well, I think the first thing is we feel that they are working and doing the job that was intended for them. And we've said that we always want to achieve a better balance between supply and demand in the housing market. And so we would not want to remove these LVRs if a situation were to occur where house price inflation would just start accelerating again. So we wouldn't want to see that.
Also, the monetary policy statement talks about a significant increase in cowrie issuance over the last 6 months or so. There was concern during the last rate hike cycle about Eurodashies and the pressure that put on the currency. What's your view this time around on that sort of cowrie issuance and whether it is a factor in the currency being unsustainably high?
Maybe Jason can talk about cowrie issuance. I mean, there has been quite a lot in the early part of the year. The Eurodashies haven't been a factor. I mean, if you look at Eurodashi type transactions, you saw a lot of activity in emerging markets, particularly emerging markets in Asia, in parts of Latin America, Brazil, and elsewhere. And given what's happened to exchange rates in some of those countries since May of last year, the demand amongst Japanese households for Eurodashi transactions has probably abated to some degree. We haven't seen it to this point in terms of the best data that we have. We haven't seen it pick up in New Zealand, which is not to say that it wouldn't. But we haven't heard that it has been picking up.
You've also said that the currency is unsustainably high over the long run. Should the Reserve Bank either intervene in the currency markets to pull it down or warn of an intervention, as we've seen in other markets, including Australia?
I think I mentioned before that daily turnover on the FX markets are around $100 billion. Most of those transactions are in New Zealand, US dollar transactions, and 85 to 90% of them take place offshore. The opportunities for intervention, and given those sorts of flows, are extremely limited. Thanks very much indeed.